Cathie Wood was one of the top investment managers in 2021, managing a huge $68 billion of investor money. Now, Cathie Wood actually shot into the mainstream in 2020 as the Ark ETFs went on an absolute tear. The flagship fund, Ark K, shot up 143%, outstanding performance which caught a lot of attention from the media and investors. Investors began jumping in, wanting a share of these lucrative gains. However, in 2021, it's not been a great year for Cathie Wood and the Ark ETFs. The same flagship fund is still down 20% on the year. And what makes it worse is that for passive investors just holding the S&P 500, they enjoyed a huge 25% gain on the year, the best annual gain in years. However, we are now approaching a brand new year, and the big question is, which is going to be the better investment in 2022? Investing in the innovation sector or just buying the whole market index fund? So in this video, we'll be looking at the strategy of Cathie Wood's and Ark Invest for 2022. We'll look at inflation. Will inflation get out of hand next year? And then finish with the question, out of all the Ark ETFs, which one does Cathie Wood believe is going to outperform the rest in 2022? As always, if you do enjoy anything in the video, then drop a like, always appreciated. Okay, so first up, let's just do a quick overview of what Ark Invest is all about. Basically, they go against the grain and they don't invest in the whole market. They've selected just the segment which is pure innovation. And it's 5 sectors that they believe will have explosive growth over the next 5 years. And these include blockchain technology, the genomics revolution, robotics, artificial intelligence, and energy storage. And she believes that these sectors will massively outperform the index fund, or benchmarks as she calls them. Take a look.
Our focus is solely on disruptive innovation. We are not a generalist portfolio team. We are focused on the 5 platforms, innovation platforms, and 14 underlying technologies. Our analyst responsibilities are broken out by those technologies. They are specialists when it comes to the technologies and generalists when it comes to the sectors. But we're focused only on disruptive innovation. And we have a study up on our site which would suggest that because most asset allocators are short innovation in the public equity markets, that if they were to include our portfolio, let's say our flagship portfolio, perhaps 10% of their equity allocation to our flagship, and then if they were to use the benchmarks for value and growth over a 5-year period, and we did this study based on facts, our own experience, over a 5-year period, Ark's strategy would increase returns and lower risk because the correlation of our returns with other strategies is very, very low. So that's the primary reason we depend on asset allocators, advisors to allocate as much or as little to our strategy. One thing I will say is, given the massive amount of innovation taking place right now that is going to be highly disruptive, we do not believe that most asset allocators have enough allocated to innovation. And I think that the traditional benchmarks talk about risk because of these innovation platforms, DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technologies, because those are going to rip through the traditional world order and disturb it mightily, that those benchmarks are probably where we're seeing the bubble today.
So if investors were to allocate 10% of their portfolio to innovation, their research shows that this will increase your returns and lower risk. Interesting. Okay, next up, what is going to happen with inflation next year? Is it a legitimate threat? The most recent numbers show that inflation is at a 40-year high in the US, and the reason inflation is important is because different investments and segments do well in times of inflation or deflation. And from what I can see, consensus is beginning to build that we are going to be getting inflation and that it wasn't transitory. However, Cathie Wood does see things differently. Take a look.
What I find so interesting about this is that the market's multiple, broad-based market, so S&P's multiple on next year's earnings is at 24 times. NASDAQ's is at 31 times. These are near record highs, except for the tech and telecom bubble. If inflation is really the risk out there, why isn't the entire market's multiple coming down? I remember when I started in the business, late 70s, early 80s, Art introducing me to Capital Group on the West Coast, and I'll be forever grateful. Back then, I think by the end of the bear market in 1982, the market's multiple was down to 6. I just mentioned that we're up to 24 on that basis right now. Now, you're going after multiples in our space, and what has happened, the depreciation in our stocks from mid-February to today has not done anything to our forecast. We're now just getting our forecast, we're now just getting our companies and our stocks at lower prices. So in mid-February this year, as we did our 5-year forecast, and we assume massive multiple compression during the next 5 years to something like FANG multiples, EV to EBITDA in the 18 to 20 range. When we did that in February, at the peak of our strategy, the compound annual rate of return we expected from our portfolios was roughly 15%. Today, doing that analysis, some of our projections have increased. The compound annual rate of return we are expecting is close to 40%. So in February, we were expecting a doubling over 5 years. Today, we're expecting nearly a quintupling over 5 years.
And that is a masterclass of how a money manager can never lose. If the market goes up, then you are a great money manager. However, if your funds crash, then all that means is that investors are going to get an even greater return over the next 5 years. Okay, to finish up, as mentioned, Cathie and Ark focus on 5 main markets: blockchain technology, genomics, robotics, AI, and energy storage. So out of these 5 markets, which one does Cathie Wood believe is going to outperform in 2022? Check it out.
Can I ask you just sort of where you're looking at the markets with all your platforms? I think it's 5 platforms you do. What are the areas you really think are big winners coming forward, and what are the losers? And by the way, I don't want you to mention Biden in the loser category. That's my job. I'm just joking.
So I think the platform that has been hit the hardest in this correction is the genomic revolution. And the reason is many of these companies are losing money. We're in this is a movement in its infancy. And I think the most exciting thing is we can now isolate mutations in and among our 6 billion bits of code in our genome. So 3 billion base pairs, 6 billion bits of code. Until recently, we could not isolate those mutations. Mutations are the earliest manifestation of disease. And now what we're beginning to understand is the convergence between and among DNA sequencing, artificial intelligence, and CRISPR gene editing, as well as other gene therapies, is curing disease. We have functional cures now for beta thalassemia, sickle cell disease, ATTR. Now, these are blood-related diseases, but the companies involved are now focusing on some of the most complicated diseases like diabetes. And what we're learning from companies like Freenome, which is a private company focused on the convergence of AI and DNA sequencing, we're learning that the body sets up for disease, and that artificial intelligence is able to discern when that setup is taking place. So wouldn't it be wonderful to discover cancer in phase 1 or stage 1, or maybe even before?
So after an epic run in 2020, Cathie Wood and the Ark funds have struggled in 2021. However, we are about to enter a brand new year. They are 100% committed on these 5 innovation platforms, and they believe that they will quadruple over the next 5 years. They do believe because of technology and innovation, we will be seeing exponential growth over the coming years with no signs of a market crash. And out of the 5 innovation platforms, she believes it is the genomic revolution that could outperform next year, as this was one of the hardest hit this year. As of right now, the genomic ETF Ark G is still down almost 30% on the year. And this is yet another great example that people like to chase and buy what's going up, even though the investing principle is buy low, sell high. But as you can see, it's easier said than done. Should you buy when something is 30% down or 150% up? Because most people do the latter. So there you are, guys. Hope you enjoyed. Do you think that the Ark funds are due a reversal in 2022? Let me know what you think below. For now, just to say, if you did enjoy anything in the video, then drop a like, and a big thank you to everyone who does. If you haven't yet subscribed, click below and join us. Got some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.